Jared, who do you think might be in the running? Like, I'm looking at my list of tech stocks that I cover to see who might be next, but what do you think?
Well, hey, John. Hey, Kelly. It's a fascinating question because right now there are 20 other stocks in the S&P 500 alone with share prices above $500 a share. I mean, we saw Google, we saw Amazon. I think two data points makes a trend. And we looked at these 20 other names that are, prime candidates, we think, for a split. And Dom's exactly right. 12 months after a split, since 1980, if you look at the data, stocks that have split are up on average 25%. The market's up on average 9%. So there's some interesting things to learn from history. Right now, I can tell you that those 20 names in the S&P 500 account for almost $6 trillion in market cap. That's almost 16% of the total. It's a big group.
Okay, so I was looking at some tech stocks that are over $400 a share. So maybe a little lower bar than you were talking about. I got some names like Adobe, Intuit, ServiceNow, Palo Alto Networks, Shopify, Broadcom. Yep. But if some names are coming way down off their highs, will that make companies skittish about doing splits?
I don't think so, because it's not just tech stocks. There's a lot of consumer names in there. I mean, we see companies like AutoZone, Chipotle, even a financials like BlackRock all seem like they're prime candidates for this, because ultimately this is not about the technical details. It's about management signaling that they're friendly to shareholders, whether it's through a buyback or through a stock split or through new capex. They want to show that they want to run their business well, but they also care about returns for their shareholders. And a stock split is a free and easy way to do it, while, as you say, bringing more investors to the table through a lower nominal price.
Jared, how much of this is about getting into the Dow?
That's a great question. I don't know if that's a top concern for a lot of managements, although certainly it matters sometimes, and there's some interesting historical studies on that too. I think ultimately the number one concern right now, given the tightening liquidity in the market, volatile conditions, I think managements are more eager than ever to show their shareholders that they're ready, they're willing, they're listening. It's a very different tone from maybe 3 or 4 years ago, when some companies maybe pursued policies that were not so attentive to what shareholders wanted to do. I think you've seen a big tone shift today, and that's why we think that there are more splits likely to come in the future.
Jared, I wonder how much of this, looking at the impact of stock splits, is looking at correlation and thinking it's causation, particularly when it comes to certain technology companies that increasingly are paying employees, especially highly valued employees, in equity more than in cash. Is it possible that sometimes these splits are about giving those employees flexibility and, the growth expectations of those companies, the way they're compensating employees, has more to do with their success in the future than the fact that they split the stock and trying to be friendly to retail investors or even institutional investors?
Yeah, it's a great question. And I think you're right that there may be a chicken and an egg situation here. Do companies split shares because they've already done so well, or do they do well because they split their shares? I think ultimately what we find in the historical data is that it's firms that have great businesses, that have really strong momentum, that are able, obviously, to see their share prices rise to really high nominal levels over time. You don't see failing companies priced at $1,000 a share most of the time if they started at 500 a few years before. So there's an element of success that's in there. And I think that aligning employee compensation and management compensation with the success of the business is always a great idea. And so it may simply be that stock splits are an indicator, not necessarily a cause, of course, of companies that are really well positioned in their industry, the kinds of companies that investors want to be a part of.
All right. So maybe I was just splitting hairs. All right. Jared Woodard, thank you.
Thanks.
Still ahead, we've talked a lot about U.S. tech stock declines, but it's nothing compared with what's going on in China right now. The Crane Shares China Internet ETF is having its worst day since December. It's underperforming U.S. tech this year. We have more details on that. Plus, heavy is the head that wears the crown. The strength of the U.S. dollar could be bad news for global consumer brands.
Shepard Smith here. Thanks for watching CNBC on YouTube.